tonight's theme was basically, hey, how do you make money in this choppy environment? And we often say that volatility is not the friend of a swing trader, and that's all we've seen since going all the way back to early August. When you look at the average, the ATR, for instance, on the S&P, you just have these massive candles, and every other day it's a big down candle. It's a reversal candle. It's just chop, chop, chop. So, we've been 1 minute you get a buy signal in the market where it looks like we're going to head higher. We've got accumulation days going, and a day or two later, the market comes crashing in. So it's a very tough environment to navigate. And one of the main reasons is that when you trade, you want to trade based on a rules-based system. You have to have trading rules. And we have a set of rules, the defined rules as to what a setup looks like. Why are we going to take a particular trade on? And so every trade starts with a trigger. In other words, a price at which you enter. What share size you're going to take. And then, of course, what your stop is going to be, what's your stop loss. We don't set physical stop losses, but we have a specific stop loss that if we hit that, then we're out of the trade. And then, of course, the target. And, you have to have those things in mind. Well, in order to get a quality trade, we're always looking for trades where the setup will give us a 2-to-1 or better profit to loss ratio, risk reward ratio. So if we're entering a trade and we don't see that the numbers are behind us, at least 2-to-1, then we're not really interested in the trade. And the main reason is that you're only going to win. I mean, even with our methodology, if we are correct 60% of the time, which we are about 60% of the time, you would have to have much higher winning percentage than that in order to make money. If your trades were just 1-to-1, it would be very difficult to make money in any market. So we're looking for 2-to-1 to 3-to-1 risk reward ratios. Well, one of the problems that you run into in choppy markets is you don't get those risk reward ratios, and things don't set up, they just gap. So you'd have to just say, oh, okay, well, I'm just going to get in here because we're going to gap down this day. There's nothing to indicate based on our methodology why you would get in. So once again, when you're in a choppy environment, not only do you have to follow your rules pretty closely, you have to be patient. That's the other thing. Over the past several weeks, until the last 3 or 4 sessions, 5 sessions, we haven't put on many trades at all. And there was a big lull, a several-week lull. And of course, both clients and prospective clients, people taking trials to our service, it can be frustrating because there's no action. Well, there's no action because there's no actionable setups. And that's, we always say that that cash is a trade, cash is a position. Sometimes you just need to be on the sidelines. So, if you want to be a successful swing trader and you feel like you have to trade every single day, it's probably going to be pretty hard, because I'm not aware of any systems that you can consistently be in the market every day and get quality triggers that are 2-to-1 winners, 2-to-1 risk reward ratios, and be successful. So patience is critical, and that's one of the keys in these choppy markets. All right, so you have to be rules based. You have to be patient, and I think the other thing is when you're, especially in the beginning, when you're taking on trades when it's not a real sure trend or you don't have really clear signals. Meaning when I say signals, when you don't have a clear direction in the market, sometimes you have to pull the trigger quickly on a trade. You don't want to do that. You want things to go to your target, but when you're first seeing setups that are going to be quality setups, sometimes you'll get spooked out of a trade early, and that's just going to happen. It's just part of the nature of trading. particularly in these choppy markets, because the reversals have been so sudden. And just by example, I mean, look right here what we had. We opened at the high of the day, and we closed at the low of the day. We opened at the low of the day. We closed at the high of the day. Open at the high, closed virtually at the low. Open open just below the previous day's close, rally way up into the trading range, and then sell off to close near the lows of the day. So those 4 days, that's just insane price action in the broad market, and that's what stocks were doing. So it was so easy to get shaken out of a trade, but once again, you have to have the clear setups. Now, to show you some recent trades that we've done that where we've had good success. Here was one of the first ones we took on when we had a legitimate setup. We got into GDXJ. Unfortunately, we didn't profit big time from the move. We booked a decent profit, but this was one of the first trades we got into when we started to get some signals. In this case, a short signal. And because of the whipsaw action in the market, we decided to get out. We got in at $29.34 short. We did that on this day, which was the 12/6, and ended up getting out 2 days later, and booked about an 85 cent profit, which wasn't bad. And of course, after that, GDXJ fell apart. But I think what this demonstrates is that it's very easy to get shaken out of a trade early on, just because of nervousness about the whipsaw market action from the previous 4 days leading up to this trading day. So if we go further here, let's take a look at a couple of trades that we took on after this one. Our entry signal is a question there. The entry signal on this one was the fact that we had come up above the 20-period moving average. Okay, we overcut it and sold off. So we had a big move above. We call that a shakeout move. And then if you notice, for 4 days we consolidated here. And then once we took out this 4-day low, we're really the low of this second reversal candle. So we reversed on this day. We reversed on this day. We entered below that reversal candle, and that was our signal. That was our trigger. Once again, had we had a little more confidence in the broad market, we would have stayed with the trade a little bit longer. But that's just the nature of the environment we've been in. And this trade, like I said, was just a few days ago that we entered it. Another one we had, EUO. EUO is one we're willing to stay with for a while, because EUO has been was showing relative strength. In other words, the euro, this is the 2 times inverse for the euro, was showing relative weakness for quite some time. And we had been tracking this and noticed the consolidation that had occurred over this 5 or 6 day period. We entered the trade on this gap up. So once we cleared this resistance, we entered the trade, and we sat through a little bit of chop action. We got the pullback, no big deal. We held support at the 20 period, and then we got the breakout day, and then we sold into this day's rally. And really, our target on it was 1980, and the reason being that we had resistance at the prior swing high right here around 1994. So our philosophy is, when you get a nice move like this, we're not looking for 100% of the move. I mean, it's just not realistic. We're looking for that middle 70% of the move, and that's really what we captured. We captured a 70-cent move out of a total move of if you caught the dead high, it would have been somewhere around $20.30. So we got the meat of the move, as we say. And now EUO is setting up again, where it could provide another entry here soon. It looks like it might be forming a pennant formation. basically, our entry on this had to do with a couple things. One, irrespective of the price action, the long-term movement in the accumulation distribution line, it was uptrending. So even though we were chopping around, we didn't have a distinct uptrend in the ETF coming into this point. We really didn't have the ETF wasn't really uptrending per se. We were showing institutional accumulation based on the accumulation distribution histogram, which basically we're looking for divergences. But most importantly is we had this consolidation period. We went sideways for 1, 2, 3, 4, 5, 6 consecutive days. So after we broke back out, we gapped up, we broke out, we held support for 6 consecutive days, which gave us a trigger point right above this high. And we gapped up that day, and we bought into the gap up. And of course, like I said, we got so we had our trigger above the high, which was on what 1121. That was our trigger. And we have some rules that that determine whether or not we enter based on a gap up, and that that's something that we provide to our membership. And we were just looking at the next potential resistance level as a target. But anyway, if we go to the next one, what do we have here? GLL. This one is interesting. We opened the trade on 12.9. Okay. We had a accumulation distribution divergence. Notice that the price action, the red dotted line, price action is dropping. And here we have the red dashed line, accumulation distribution is uptrending, which is telling us that institutions are accumulating. The big boys are buying into the weakness. They're buying into weakness. Now you cannot use accumulation distribution as something to trigger a trade. I mean, it's not that exact of a measure, but over long periods of time, it gives you important information so that when you do get a setup eventually, then you have an entry. And what we had here was a tight consolidation for a 5-day period. We had an undercut test of the 20 period moving average, and then we had a gap up day. And notice the volume spike. Volume was really quiet pretty much for like 10-12 days. All of a sudden we get the first spike in volume that cleared the 50 period average, 50 period volume moving average, which is the green line. That was the first time in like 2 months or so. So we entered the trade on the 9th. Wait, was that the 9th? I take that back. It would have been on the gap up day. Yeah, on the gap up day, which would have been the 12th. I actually put the wrong date in there. And then, of course, once we broke this high, we got out on the second day of the move, which was right here at about. It actually was the average price we got out at was $19.19. We actually phased out of the trade. We legged out of it. Part of it we got out at like maybe $19.08 or something, and then the other part was like around $19.40 or something like that. For the average price that we got out was $19.19. So once again, we were looking for the meat of the move. Now we got some pullback, a little bit of stalling action here. It looks like we might head higher and go up into the 200 period moving average. But once again, we're looking for that middle part of the move. We're not looking to catch all of it, and we booked a solid trade there. The other trade that we're still in, AGA. By the way, today that's a bad tick. That was like 100 share block at the open. Somebody must have had some type of order out there and it got filled. I don't know. Something weird happened, but that's not a legitimate candle. Basically. What we've been looking at here was AGA. If you notice, since like early this year, has been moving sideways, consolidating between $16 and $20. $16 on the low side, or $14 actually, and about 20 bucks right there. So we had a long-term consolidation, even though it's at the lows. That's a rounding pattern, which is, offers the potential for a bullish breakout. And initially, what we did is we entered. We had a pullback. This right here was the sixth test or the fifth test of that $20 area. And what we had then was a pullback, an undercut, some sideways action, and we entered on this day as we overcut the high of this candle right here. So when we overcut the candle on 12.7, as soon as we got above the candle, 12.7's candle on 12.8, we entered the trade. You can see there was some really crazy action over the next 2 days because it's a pretty low float ETF. And now, if we can hold here, that's the whole key. Now we have a trade. We're in at $19.80, and we've broken above this almost 9-month consolidation zone. So if we hold up here, this thing could really rip from here. But we're still in the trade, and because it's a low floater, we actually upped our stop on this today. Yeah, we upped the stop on this today. So that's another thing that making money in this type of environment is, hey, you got to play it smart and maybe play things a little bit tighter than you normally do. And we up the stop to a break-even stop. We're just not willing to just give things back in a choppy environment. All right, so anyway, that's what I have to say about the market. I mean, you have to have rules. You have to be patient. You can't just think you can get in on any trade, and you'll get chopped to death in an environment like this. And sometimes at the beginning of a move, you've got to be willing to get out of it quickly, even if it hasn't run its course. If you just don't have a good feeling about it, sometimes you got to get out of a trade, even if it means taking a smaller profit than you normally would. But you definitely have to have a rules-based system because otherwise you're just going to get chopped up, and that's where the patience comes in. So what I'm going to do here now is turn things over to Rick. He's going to have a few things to say.
What I'm first going to do is run over some of the broad market averages and how it applies to our strategy, what we do in the stock sheet. And for those of you who do not know about what we do, we have the Wagner Daily, which trades ETFs, and we have the MTG stock sheet, which trades stocks. And the basis of the system is we look for momentum breakouts in stocks that are trading near 52-week highs, and we focus on small and mid-cap stocks. So let's get, now that that's out of the way, let's get to the markets themselves and give you a little bit of a background on what we look for when a market's attempting to bottom out, what we like and what we don't like about the current market conditions. Okay. The recent rally off the swing low in November, there was a good thrust behind it, a powerful thrust. There was some decent accumulation at the beginning, and over the past few days, we saw distribution on 12.14 in the Nasdaq, 12.13, and on 12.8. So 3 out of 5 days are distribution days. So right away, that puts us in a cautious mode as to going long. And on top of that, the price action is now back below the 50-day MA. So when you have distribution days clustering and the price action dives back below the 50-day moving average, we really don't want to be too involved with establishing new long positions currently. And for further confirmation of that, in recent long positions that we've had, such as SEMO, which we bought around 20, broke out, and then 2 days later failed to break out to new highs and came right back into the 20-day MA, and where we stopped out with a small loss. And now it basically has to set up again. So stocks like SEMO, QCore, Q core is another false breakout to new highs and came right back into the 20-day moving average. So when you combined a few of these false breakouts with distribution days and the the broad market averages below their 50-day MA, the picture is, negative in the short term in terms of long setups following through. So we right now our model, we're back into cash, and our model suggests that we take it easy on the long side, and we try not to predict what's going to happen. We only try to figure out where we're going to go from what has already happened. So what we're going to do right now is just take a wait and see approach and see what the markets do here. I mean, do we go higher? Do stocks go higher? Is there more accumulation, or do we roll back over? Is there more distribution? Clearly there's no need to predict anything. We just have to, see what's going on in front of us and not try to have any opinion and then merely trade off of that. So other than going to cash right now, what we're also doing is looking for short setups. Now, the market's already sold off quite a bit here over the past week, so we don't really want to chase any short setups around this level right here with the SPY just below the 50-day MA. We could keep on rolling over here down to 120, maybe even to 116, who knows, but odds don't favor any short setups right now in terms of risk reward. So we're basically waiting for a 2 to 3 day bounce up, maybe somewhere into this level here. And I know it's kind of a little bit of a wide level here, but anywhere from 124 to 126, but we really don't know how we're going to play these shorts until they pull back. So in terms of short setups, what we're looking at right now is win. I'm going to give you a basic rundown on our short setups. We look for stocks that are trending lower with the 200 AMA rolling over or about to roll over, the 50 AMA in a downtrend, and the 20 AMA in a downtrend. That's our core trend qualifying concept right there. We have to have all those moving averages moving in the same direction. And so with win, we basically had a false breakdown to new lows. Usually attracts a bunch of short sellers, but this is never, for us, never the time to sell short at an obvious low. So we'd love to see a pullback into this moving average, even to overcut the 20-day over the next 3 to 4 days. That would be ideal. Now the price action may just bounce 1 or 2 days higher and then go sideways and roll back over. Depending on how much of a bounce we get, will basically determine our entry and what we do. And same thing for price line. Now, price line is a little bit of more of a transition play. Is the moving averages are not clearly in our favor, but we clearly see that there is distribution here in the stock, and it's recently failed to hold the 460 level, so we could see a bit of a bounce here. And if we got anywhere near this 20-day moving average in the short term, we might look to take a shot on the short side, somewhere around the 470 to 480 area, if it indeed does bounce higher. Other setups we're looking at is GIMSER. More of the characteristics we look for in a short. Lower level base at the lows here. Broke the uptrend line, has sold off. We'd love to see a tight sideways consolidation or a slight bounce to the 20-day moving average as a potential short entry. As you'll see, none of these setups are really actionable at the current moment due to market conditions, but these are definitely some of our top tier short. These stocks will make our top tier short watch list here. So APKT is interesting here. It could potentially roll over beneath yesterday's low, but if that's more of a shakeout, if one does get short below yesterday's low, a stop above the high would be an ideal place to get out. Ideally, we'd love to see the action bounce for 3 days higher, overcut the 20 DMA, as it is forming a lower level base here at the low. So, below the 20 and 50 MA slope and the 200 MA being lower. And WLT, pretty much the same thing here, broke down below the prior swing low, but it's a bit of a of a shakeout here as it's back above the 63 pivot area. 2 to 3 day bounce into the $70 range would be an ideal short setup for us. And that's it for the short setups. As far as the longs, we've already mentioned what a few like Q Core false breakout. It's still holding up well, and it's probably going to be one to watch over the next week or two to see how it reacts. We definitely want to see it hold above the prior swing low here. If it does in fact come down and touch the 50-day MA, that would probably mean this setup needs another 4 to 6 weeks of corrective price action to form a proper base again. CMO is the same thing here. Really should hold above the $18 level. A move below 17, and we might need a few more weeks of consolidation. Pardon me. As far as pullback setups, stocks that have already broken out, we're looking at STA. Great breakout here. Basically, the needle in the haystack breakout. One of the very few breakouts that have worked. So any pullback to the 20-day moving average here might be an opportunity somewhere around this area here. If there's a 3 to 5 day pullback, might be an opportunity to get long. There is one potential long setup here, but due to market conditions, it is rather, the odds aren't in favor of this setup. But Medivation has pulled back here and formed a bit of a reversal bar today. I'm sorry, and is a potential buy entry over the 2-day high here. I see that better, a little bit better right there. So breakout above the 2-day high would be a long entry with a stop beneath today's low. I keep saying yesterday. So and again, this setup is not ideal due to market conditions, but if you're looking for action and you want to take small, it is a potential long setup. And it has great relative strength here, and it is a very explosive situation that has jumped from the 20, is basically doubled in the past few months. And the last one we're looking at here is another explosive situation, but this needs a few more weeks to consolidate. INHX, is almost quadrupled over the past few months. We love the thrust up, and what we'd like to see here is a few weeks of sideways action here, maybe 1 or 2 weeks around the 12 to 14 area, and then a break of this downtrend line, and then another week or two to form a handle, and then the breakout to new highs. That's ideal price action. Most of the time the market doesn't act that way, but that's what we're looking at, just to give you guys a bit of an idea. So that's pretty much it from here. We're basically in cash right now, waiting for long setups. Waiting for short setups to develop on a bounce. And if broad market conditions improve, we might take a shot on the long side again. But as for now, we're going to stay away from the longs. So it's back up to you, Ed.
Okay. Yeah, as Rick was saying, basically, you can't fight the market. And I think what happens is a lot of times, a lot of traders, they get into the mode of trying to wrestle and fight the market. And one thing that helped us over the past several days is that in trading ETFs, the fact that we also trade and provide setups through our services for ETFs, is that if you notice, the things that have worked in our favor were commodities, GLL, currencies, EUO, things that have a lower correlation to the market, or in some cases they might trade inversely to the market, but other times they correlate less directly to the market. And then GDXJ, junior gold miners. This is where the opportunities have been, and we didn't try to force it by manufacturing trades and trying to deal with all the whipsaw that you were seeing in your standard stock-based ETFs. The price action was just too whippy, and we were getting the kind of setups. So that was that's a big advantage when you know how to trade, and you do trade ETFs in addition to stocks. That's very helpful. But look, at the end of the day, you got to have that plan, and obviously it doesn't hurt to be listening and working with people that do this for a living. Not only do we provide this service, but we actually trade money. We actually trade a hedge fund. So we have plenty of experience in trading, and the trades that we post are the trades that we also take the same trades on in the fund. So we don't we put our money where our mouth is, I guess is what I'm saying. And if you go to our website to morpheustrading.com, you can see, there's so many services out there. They'll put out 100 trades a day, or 20 or 10, and then 8 of them don't work out, 2 work out, and the only 2 they talk about and brag up are the ones that worked out. Well, I mean, anyone could do that. I could pick 20 stocks a day and have, some of them are going to work and some of them aren't. And then, what am I, a genius? But, we don't just do that. We provide the actual picks. We provide share sizing. In other words, what size should you take on based on your portfolio? What your stops are, what your entries are, the trigger prices, and then, of course, what your targets are. And if you go to our performance tab, you can basically, so for ETFs, you can see the quarters going all the way back to 2002. You just click on any one of these and you're going to see, here's the trades, there they are. And these are the ones that are in the newsletter. So whether they win or whether they lose. So in this case, we had 1, 2, 3, 4, 5, 6 losing trades. And then we had about 10 or 12 winning trades. So, the proof is in the pudding, as they say. We put it out there. We show what we do. We don't hide behind hype and that type of thing. So we welcome you to come to the site. You can. Here's our various packages. I just want to show you that if you go under services, you're able to see the various packages that we offer. We have the Wagner Daily, which is which I write the Wagner Daily, and that's for the ETF picks. The mortgage stock sheet, which is Rick's baby, and that deals, of course, with stock selection. And then the portfolio trackers is a weekly publication we put out. It's more of a little bit more of a longer term perspective, a little longer than our swing trades. Our swing trades typically will last anywhere from maybe 3 to 20 days, and the portfolio track is more position trading, a little longer term, up to a couple 2-3 months. And I welcome you to go out there, take a look at the services that we offer. Oh, a good question, Richard. Are our trade recommendations intraday or end of day or what? Yeah, our trade recommendations, I'd say about 70% of them are end of day. So you get the newsletter that night or in the first thing in the morning, and it's going to have the setups for the recommendations. They're going to be on what we call our watch list, and if they trigger, then you enter. And the other 30% are going to be intraday. We send out intraday alerts that can go to your email. If you sign up for membership, we also, within this, we have a community chat that we run every day, Monday through Friday. So you can log into our chat room. We'll post them in there. We'll send them via email. We'll also send them directly as text messages if they're intraday. And we also send intraday. We send all alerts out if we exit positions. So if we're in a trade and we exited early, or it hits our target or whatever, we send out the alerts via email and text. The best value, what most people sign up for, is a diamond membership, because what it does is it gives you a yearly access to all 3 services. It gives you access to the Wagner Daily, the mortgage stock sheet, the portfolio tracking. I'm sorry, the portfolio tracker. You get access to the community chat, and with the community chat daily, this occurs daily, Monday through Friday, just in the morning for the morning session. You also get on Mondays and Wednesdays at 12 o'clock, and then at 12:45 we hold live webinars, question and answer webinars for any questions you might have. The one at noontime is for the Morpheus, the Wagner Daily, the ETF newsletter, and the one at 12:45 on Mondays and Wednesdays is for the stock sheet, which is the one that Rick runs. But you can, if you just go to the website, I'll post that again, and you can go through all the packages, what's included. But it's a comprehensive service. We've been doing this for 10 years now, been very successful at it. But the bottom, like I said, the bottom line is, we trade what we trade what we recommend and what you trade. We stand behind our services, and we don't always win. I mean, we post losing trades, and when we post them, a lot of times we'll give you analysis of why we felt, what mistake we might have made, or why it was a bad trade. Sometimes it's just not every trade wins. There's nothing you can do about it. One thing for those of you who haven't signed up for a free trial within the past year, you're able to go to the home page. Let me get back there. And you can receive, free instant access for a free trial to our methodology. So if there's any other questions there, I'm going to look here. Looks like we got a chat box flashing here. Okay, Rick, you answered that. If there's any other questions out there, please go ahead and post them now. We'd be more than happy to, field any questions you might have. By the way, one other thing I want to mention is that Darren and I have 2 new books coming out. One book is basically an update to one of his previous books that I helped him with, and then we have an advanced technical trading with ETFs book coming out next year, a completely brand new book.